Good afternoon, everybody. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure is basically the same as yesterday, except I'm back in the SPXL short. It's the only difference. Okay. So we got Google out after hours here and trading up. I think the measured move was to like 168 or so, 168.50. So we did trade a little bit above that, but now we're back below it by a bit. Let's take a look at the numbers. Alphabet, ad rev beats by a little bit. Operating income beats. Q1 revenue beats. EPS beats. YouTube, I like the YouTube number. Small miss on YouTube. Very small miss. Basically in line. And Google Cloud is also a small miss. That's interesting. Alphabet says we surpassed 270 million paid subscriptions. The cloud revenue is a little bit of a miss. They approve additional buyback of $70 billion. Well, that helps. And quarterly cash dividend of 21 cents. Okay, so they beat on the numbers there. We don't have any guide, right? Maybe guidance comes out on the conference call. And that's probably going to be the most important thing. The numbers here are fine. Google ad revenue beat is good, and that seems to be helping names like Meta move higher. TTD, which I'm in, is moving higher. I was able to sell some into the initial pop that came from Google and TTD. So it seems to be helping kind of the ad rev complex. I think that's really important. But it's interesting to see that YouTube is only in line, especially, man, like, I watch a lot of YouTube. I throw on like music videos sometimes while I'm working. So I watch a decent amount of YouTube, and the way they hit you with the ads now is like insane. It's like 2 ads when you start, hitting you with ads in the middle of whatever you're watching, hitting you with more ads at the end. I don't know if they can increase that any further. It seems to be pretty saturated to me. I mean, YouTube is just phenomenal in terms of a business. It's the best streaming business that's out there. I think it's better than Netflix. But I don't know what they can do with that in terms of increasing the ads on YouTube. But with that said, I think it's driving more people to actually become subscribers, because if you watch YouTube at all, the ads are just getting so ridiculous. So I'm actually in the process, literally right now, with a few friends of all kind of teaming up a little bit to do like a family plan, which I'm sure eventually they'll stop, similar to Netflix, where you all have to be at like one IP address or whatever. But the YouTube ads is just kind of crazy if you watch much YouTube. So it's interesting to see that only is basically in line. And the cloud revenue number miss is interesting. But we got to see what guidance looks like. Maybe we'll get guidance on the call or lack thereof, because we've got, yeah, for sure, David. I'm sure it is. So we've got. We'll see if they provide guidance, because a lot of companies now are starting to withdraw that guidance. I think, did something else just come out after hours? It's an important name that withdrew guidance. So we got Intel out also. TTD still going. Intel sees second quarter revenue light. So Intel is trading down. What else is new? Meta, Amazon follow Alphabet shares higher after earnings beat. It's interesting because Meta higher makes sense to me with the ad revenue beat. I think there were some concerns around that with Google's report. But Amazon, I feel like, would move more on the cloud number, which was a miss. So that is interesting. It was Timus that just withdrew there, or is that just moving after hours? I could have sworn I literally just saw something at 4 o'clock that said that they weren't going to provide guidance, but maybe I imagined it. We know that there's a lot of companies right now that are doing that. There's a lot of companies out right now that are withdrawing their annual guidance, but so far aren't really being punished on it, which is really interesting. So they're treating it a little bit more like this COVID situation where they're not really punishing these companies on that, which I'm kind of surprised. Oh, Skechers. Oh yeah, okay. So Skechers said that they're not providing guidance, and a company like that not providing guidance makes perfect sense, because I assume I don't really know anything about Skechers business, but it's sneakers, right? So I doubt that those are being manufactured, even though the name of the company here is Skechers USA. I'd be surprised if any of those sneakers are actually made in the USA. So probably almost impossible for a company like this to be able to provide any guidance when they have no clarity on what the future of their business actually looks like, because they have no idea what their costs are going to look like. From Dave here, Skechers shoes are primarily imported from China and Vietnam, while Skechers has a global presence with manufacturing facilities in several countries. These two Asian nations are the main sources for footwear production. Yeah, it makes sense. Makes plenty of sense. I did also, sounds like a couple of you guys are trading some Google after hours. Tate, Pat, I also had a little bit. I was selling a little bit earlier than a couple of you guys. I took my first sale like 166, which I know is less than the measured move. But I took that first sale a little bit quick. But then I had a couple other sales layered out higher, so I was able to sell some almost up to highs. Kind of had offers at every dollar, so I got some off up to like 169. I think was my best fill there. What did I not get filled in Google right there? 65. Sorry, I just gotta see something on my Google position real quick. Oh, that's why. That's why. Okay. Let us jump into the meat of our meeting here like we usually do. So it was a big update for the market today. Big update for the market. We closed up, and we're continuing to trade up after hours, but including a little bit of the after hours move higher, 2.25% in the SPYs. So it's a really, really big day. We're working towards that big 550 level that we've spoken about. Qs, which are only up 30 cents after hours despite Google. Maybe Intel's weighing on it on the other side. But Qs up 2.8%. IWM up also 2%. The laggard only up 2%. TLT, I'm not getting a quote. I've been having some internet streaming issues throughout the day today. Dollar, I'm also not getting a quote. I don't know what the deal is with this. There we go. TLT's up 1%, 1.1, and the dollar finished negative 0.4%. Google moving back lower here a little bit, retesting 164. It's retesting the ADMA on the 5, so technically this is a buy spot. You could be long versus low as it's just about to pull back to the ADMA. But not trading advice here after hours. Just saying that's a setup I like. That first touch of that ADMA, I like that setup a lot. I meant to go over this yesterday because I know it worked really well with Tesla long, and there was one other yesterday that we liked where you got that big gap on the earnings and you get that first test of the ADMA and you get like the tail into it. That long off a tail low on the first test of the ADMA on the 5 in an earnings name, that gap really big, is a trade that I generally like a lot. But anyway, super strong day for the market, and unlike most of the trading sessions that we've had recently, it was kind of just a straight grind higher. There were no like pullbacks and recoveries really throughout the entirety of the trading session. I mean, we had these little 7-minute down ticks at certain points throughout the day, but nothing substantial until 3 o'clock when we had a little bit of a bigger rollover. I know people have questions on that. I'll talk about it in a second. Qs, pretty much the same deal. The Qs were ridiculously strong off the open today. Didn't even touch the ADMA until 10:45. It was not a gap and go though. We had a flat open this morning. So Qs were ridiculously strong, and the IWM was weaker. It also grinded higher and moved higher, but it was certainly weaker. The IWM has an inside day today. let's turn things over to the daily chart, see what kind of update we have here. SPYs are starting to look fantastic. So this morning in the morning meeting, I thought that today was set to be a little bit of a tricky day because it was a flat open. I don't like flat opens. I like gaps. Gaps give me an advantage. And because we are in the range, right? We're in this wedge. Now we broke out of it today. But we're in this wedge between like this 544, 545 area on the upside and like 520 as the major level on the downside, though I know that the last pivot low is all the way down to 508.50. So we're having a flat open within the wedge. So I felt that it made for a tricky open, but my lean was bullish. Definitely bullish. As I mentioned in the morning meeting today, I actually love Monday's candle. Monday's candle where you have a failed break of support. I've been talking about this for the last 3 days straight. Failed break of support lower actually makes it even easier for the market to move up because this brought in new shorts, it pushed out longs, and when you then go higher, those shorts get squeezed. Those longs either have to repurchase or at a minimum, they're not selling and booking profit on the way up. So shakeouts of levels, in other words, make it easier for markets to move in the opposite direction. And that's exactly what we've seen. Now, today with the flat open in the range with like a moderate degree of extension, I actually thought that the highest probability situation was that we were going to have a range day today. But within that, leaning to the upside. Definitely, I am more bullish than bearish because I think that the positioning risk is to the upside. I've been saying that every day for almost 2 weeks. And I think that the headline risk for the moment is still to the upside. We are moving up more on better headlines than we are moving down on the good headlines, on the bad headlines. Did I just say that backwards? We're moving up more on good headlines than we're moving down on bad headlines. And I also think that we're still early enough in this 90-day window that the market is more fearful of the positive headline risk than the read-through on lower growth and higher inflation that can actually come in from the tariff situation. We don't see that yet. We don't see that in these numbers. We don't see it in Google's earnings report. Like anything that is backwards looking right now, you do not see any implication of tariffs in. The only implication that we're seeing at all right now of tariffs is companies that are withdrawing guidance, basically, or companies that are choosing to guide a little lower, or they mention the uncertainty that comes from the tariffs. I read a statistic today, I don't remember what it was, on the percentage of companies that are mentioning tariffs in their earnings calls, and it's like a ridiculously high percentage. And there's also an increase in companies that are mentioning the word recession in their earnings calls. And again, I don't remember what the percentage is, but it's very high. It's like every single company that's been reporting is at least mentioning the word tariff at one point throughout their earnings call. But what I've been saying for a while now is I think that there is a positioning risk to the upside where we could go after this 550 and potentially even squeeze to the 560, 570 zone of this market, which is a broader price congestion zone from March. And I think when you get that sort of move, it could be at either that price point, or if we don't reach that price point at a certain point in time, which might still be a month away from now, where the read-through and the fear on the growth slowdown actually starts to impact stocks. So we're not really there yet, and I am and have been and still am like a short-term bull on this market. And today's technicals were able to further confirm that. 550 is the huge level, but we've also been talking about this 544 area, which is basically the high from the 14th and the high from yesterday. But if we can get above that, this market will start looking pretty darn good. And guess what? We closed above it today. The only other thing to consider, though, is that the market's starting to extend a little bit. It's kind of only a day one in some ways. Yesterday gave us a little bit of a reset. But as of the close right now, we are trading at like $14 of extension in the SPYs. And I know that there's so much volatility out there that a normal $10 of extreme extension probably does not apply in the same way that it has for some years prior to this last month or so of trading. But as I also said back on Monday when we extended down by like $15 or so, I don't think that we're going back into a regime of so much volatility that we're seeing $30 to $50 of extension. Maybe $10 plus still makes sense before we're getting more extreme. Maybe you only want to really be considering those trades in the other direction when we're at like 15 to 20 as opposed to 10 to 15 like we did more traditionally. But if you're thinking 15 to 20 is that sweet spot, again, we closed at, including the after hours action here, we're almost at $15 of extension right now. So if we were to gap up tomorrow, that is definitely not something I would buy, and it's something I would consider a short-term short on. I would love for tomorrow to be like a day 3 gap up. It would only be a day 2. I don't love that as much. But if we can get a gap up to like 550-ish, we'd be really extended again on into a big resistance level where I would potentially look for some cuter shorter term shorts, even as I recognize the potential of this market to give a positioning squeeze above 550. So we can reassess that in the morning as we see how we gap and everything. I'm going to be assuming at this point that we gap up, but we still haven't seen the conference call from Google. Intel is negative, and you never know what headlines these days are going to come out overnight. So that's kind of the market wrap up update here. Things are generally looking pretty bullish with today closing above yesterday's high. Q's pretty much the exact same deal. We are retesting this April 9th high for the Q's. This 470 area is really important. It's kind of the equivalent of that SPY 550. So we'll watch that tomorrow. And then the IWM is also improving. It was a little weaker today. So the Russell only gave us an inside day. It was not able to get above yesterday's high like the SPYs and Qs were. But overall, there's been improvement here as well. 195 is kind of an important zone. Maybe a little bit above 195. Maybe more like 196 to 197. Maybe 195.50 to 197 is a really important level. So we're very close to some really important levels here for the SPYs, Qs, and IWM across the board. And the market's looking pretty productive in them. And if we can break above them, you could get a real positioning squeeze higher. I know that we crossed above one of the CTA buy trigger levels today on the SPX. So that's just what I'm talking about a potential of a positioning squeeze up, where the more we move higher here now, the more we can get forced buy-ins from this market. And that's happening as buybacks are set to really resume. Technically on Friday is when the broader blackout window ends. CTAs are buyers in any tape, but they're buying even more into an up tape. And we have just, some general support in this market. So again, overall things are looking pretty good here for the bulls. And we'll see how that continues. Trying to think if I have anything else really to talk about from a macro perspective before I kind of go into the questions that you guys have. Not really too much. Palantir just continues to be an absolute monster. 2 days in a row of up like 6-7%. We called this one out as a long yesterday, so I hope some people are long this thing and making money to the long side on it. And I guess that's all I got for now. So turning it over to questions from you guys. So I know a lot of people were talking earlier today about like these grindy trends that fairly often give us these rollovers in either the last hour or the last 30 minutes of the day. It's not perfect, and as a matter of fact, today it was not perfect because then we had a little further rally. We had to pull back at 3 o'clock, but then we had one more further rally into the close. But it is like a very, very consistent pattern that we've seen for years now on both sides. And it basically what it is you've got these grindy days that come in sometimes, these grind trend days that are just like very clearly algorithmically driven. It's not like news momentum that's coming in. It's positioning that is steady buying and steady selling that lasts pretty much the entirety of the day. It very regularly rides the moving averages on the 5-minute chart, like the 821 EMA area. Sometimes it perfectly rides the 8 EMA even on the 5-minute. but very regularly just rides the moving average area, that space between the 8 and 21 EMA on the 5-minute chart for the vast majority of the day, as there's just an underlying bid or overlying offer to the market that just kind of, it's just very, very, very constant, and you can't fight it because you really just get hurt. And I feel like we've done a decent job actually on the counter trend move that will come in on fairly often at 3:30, but not a perfect job. Maybe not as good of a job as we should have, because I know, for myself, and I think some of you guys, at certain points in those rallies, especially if the bigger picture of the market is getting really extended, we try to come in the other side too early, where especially if you've got a lot of extension on the daily chart, you're looking at like every little peak here, and you're going like, okay, like this is where I can short. But when you've got that like grindy upside trend with that underlying bid, it doesn't really seem to care how extended things are on the daily chart or anything like that. It just continues to ride this market higher. And instead of like trying to fight that trend to the short side at earlier points throughout the day, you shouldn't be. And if you're just a day trading, especially, you should be trying to ride it, because it just continues to go. And the frustrations of anyone who's trying to, short at pretty much any point throughout the day today up until 3 o'clock, then those frustrations just become your smiles, because the market just keeps kind of grinding and trending higher. And where that comes from specifically, I don't know. To some degree, it does seem like it comes from those systematic buyers and sellers when they're forced to buy or sell. So like CTAs as an example, and then you just get, again, that really, really strong underlying bid. And then I also think that there are just some pure like intraday trend following algorithms that pick up on that, and also as like a further self-fulfilling prophecy, just come in and also just buy on the moving averages for trend continuation. But then we, again, not always, but in those grindy trend days, we very regularly then will finally see a move in the other direction, either at 3 or 3:30. And I think that, and that happens on the other side also. It also happened on Monday. Granted, Monday was the other way, and it was coupled with some option flow. But look at this, 3 o'clock on the dot. That's when we had this reversal. And this move is actually more of the move I'm talking about. Today's move wasn't perfect, like I said, and it's never going to be perfect. Nothing in trading is a 100%. But we see this move happen a lot here, where you like this grindy trend lower, where there's barely any real pops throughout the entirety of the day. If anyone remembers Monday, it was like this overlying offer to this market that just kept moving down with the market and just was relentless. And then again, all of a sudden at 3 o'clock, it's just gone. And I think that those intraday trend following algorithms that I just mentioned, well, we'll start with that first word, intraday. So if they've been accumulating a position throughout the entirety of the day because they are, I don't know exactly how they're programmed, and there's probably a variety of them, but if they're just buying on every single dip and maybe selling a little bit in certain points of extension, but they've accumulated this position, then they need to sell that position for their profit into the end of the day. So then you'll sometimes see, again, it's very typical, either at 3 or at 3:30. That may also coincide with like an early MOC update. You get the move in the other direction as they just take their profit, and then if that move becomes big enough, it becomes something that builds on itself, because that pullback is maybe passing other pivot lows that trigger more stops, and then you get like a bigger rollover that's more like the opposite again of this Monday move, where, I mean, Monday we could not catch a bid for anything all day, and then suddenly at 3 o'clock, again in conjunction with some option flow, we were able to rally from 508.75 to 514 in an hour. So that is a sick move, obviously. So the bottom line of what I was trying to say was, instead of like on these days, so I on this pivot here at 205, if anyone remembers, this is how I noted it. I wrote this into the VTF. I was like, hey, a little bit of an upside tail here, It's also marked by this higher volume. A little bit of an upside tail here. You could try to short it, but it's probably too early. Why did I say that? I specifically said it's because it's 2 o'clock, and we've had this grindy upside trend all day today. And yeah, if big news came out, of course we could just sell off at any time. But it just was like, I'm like, upside tail with some volume, notable, potentially shortable. But we've got that upside grind bid that's coming in on the market, and that typically means that 2 o'clock is too early. You got to wait for 3 or 3:30 for the roll down to actually occur. So then like this pivot is a much better pivot to try to short off of. Still slightly early, but you know in 10 minutes you're going to hit that 3 o'clock time, which is one of the times in these grind trends that you get that kind of roll down. So anyway, it's just something I wanted to note because we've seen this happen for years, and I've become good enough at recognizing this to communicate to the VTF that like, hey, we've been grinding up all day here. Let's see if we get the move in the direction in the last hour. But I haven't done a good enough of a job communicating to the VTF that, hey, this is actually what's happening already. Like, if I was able to recognize that 2 o'clock, this 205 pivot was too early to short because of the type of grind up that we've been having, I should also be able to recognize the opposite side of that, which is, hey, that grind up is existing today, so we should just be buying every single dip for these little day trades to be able to make some money in. And, and then be done with that by 3 o'clock, and then potentially go the other way at 3 or 3:30, especially if there's some sort of signal that comes in, especially if there's a lot of upside extension on the daily charts. So yeah, definitely something I mentioned and something that we should try to do a better job of and note for the future, because it happens often enough. I mean, doesn't necessarily happen a lot, but it happened twice this week alone, which is probably more than usual, but something we can certainly make money off of if we're prepared for it. I think that's all that I've got on that topic, so happy to answer any other questions here. Let me take a look in the VTF. Cool, so we talked about that. Does anyone have the CLS numbers for Ben? I don't, but if anyone has them, please post the CLS numbers for Ben. Trading down on earnings. Also, if one is flat, how would you play this as we are extended? I think I just described it. I'm not sure which side of play this you mean, but it's I did. Okay, cool. Moving on from Dennis, QQQ just over all-time high AVWAP here after hours, meaning the average buyer since then is now around break-even, slightly green. It definitely has some significance. Okay, so an additional piece of potentially bullish information here on top of the CTA number getting triggered. From Dennis, if the move continues, we could be setting up for a sell the news type of trade on the first Trump trade deals. Thoughts? Maybe. I don't know is my main answer. Maybe. I mentioned in the morning meeting this morning because it just popped in my head yesterday. It popped in my head yesterday because after hours we saw headlines that said that Trump was not going to do like tariffs on cars, basically, one way or another. That was the headline. Market popped on it initially. And I started seeing that the market pop on it was really weak and that the market was then going down. And then I saw Trump came out and said that it's fake news, which one, interesting just how often that's happening. But two is when I saw that we were starting to sell down before I saw Trump say that it was fake news, my first thought, because again, these are just the things, by the way, that we need to be paying attention to as traders with the market. It's just, this is how you keep your finger on the pulse of the market. You need to know, so we've been in a pattern that I have spoken about for 2 weeks, where, more than 2 weeks now, I think, where the market is reacting greater to the upside on good news than it is the degree to which it's reacting to the downside on bad news. That doesn't have to stay that way forever. As a matter of fact, I promise it's not going to stay that way forever. It doesn't necessarily have to flip either. It might just get a little more bored and the reactions might just become a little bit more muted. But my first thought because again, this is what a trader should do who's trying to keep his finger on the pulse of the market. My first thought yesterday after hours when we started to sell down on a seemingly positive news on a reduction of tariffs on cars, which again turned out to be fake news, was, ooh, this is interesting. We should be trading up on this, and we're not. And then I was like, I keep talking every day about the headline risks to the upside. What if that changes? Because at some point it probably will change. I can see in my head a possibility in the future where we hit a point with the equity market where we're getting later in the cycle of the 90-day break, and everyone starts to get anxious because, oh my gosh, there's not enough trade deals done, and we're at near the end of the 90-day break. And I can't foresee the future. Maybe I'm completely wrong. I'm not even predicting this, so it's not even me being wrong. But maybe, we get some. Supposedly, we're supposed to get an India deal done soon. We were supposed to have a Japan deal done already, but that kind of didn't work out. At least not yet. Maybe we get a whole ton of deals done by the end of May, and the market's not even getting worried yet about the 90-day window expiring. Maybe the opposite occurs. All the data historically points to trade deals take months, if not years, to be able to do. Scott Besson himself just said yesterday a China deal might take 2 to 4 years. Maybe we hit a point where that 90-day window is getting close to expiring and we barely have any deals done, and the market starts to get super anxious again, and so much time is going by that the read-through on growth is starting to matter more than just getting a random deal done. And we hit a point where, okay, we get Japan done and the market barely goes up on it because the market doesn't care anymore. Like, okay, great, you got one deal done. It took you almost 3 months. The 90-day window is about to end, and you've got just 2 or 3 deals done, and there are 300 more countries that you have to deal with, including China, which is like our biggest trading partner, or biggest, most important, if not biggest, most important, certainly one of the top 3. So that we could see at a certain point is just the point that I was trying to get across the morning meeting today, a situation where this current market environment we're in right now, where good news is giving us bigger upside reactions than bad news is giving us downside reactions, we could see that fade, or we could see that even reverse at a certain point, where all of a sudden the market's like, okay, great, you got Japan done. We don't care because there's 300 other countries out there that need deals, and the 90-day window expires in 2 weeks, as just an example. So the bottom line is, for right now today, Dennis, I don't know. It still seems like for the moment we are trading up more on good news and up more on hope of good news than we are trading down on bad headlines. And until the market actually shows me that it's not doing that anymore, I'm just going to assume that the status quo is the status quo until it changes. But we have to pay close attention, I think, to a time in which it doesn't work out. Because the market move higher today seems like it's and really for most of this week seems it's like it's purely at this point on hopes that these deals are going to start getting done and start getting announced. So, really good question. Absolutely something we need to be paying attention to. Is it 3:45 Eastern that we know MOCs? 3:50 is when we clearly know MOCs. 3:50 is the time. There are ways, and I don't think any of us have them currently, to be able to get early indications of MOCs for several months, ending right around the time you started with SPE. I was working with some floor brokers on the floor of the New York Stock Exchange, who gave me access to a system where I was able to see early imbalances for the S&P starting at 2 p.m. Not worth. I don't have that data anymore. But the bottom line is that there are people for sure that are getting early indications of MOCs as early as 2 p.m. And then 3:50 is when you see the bigger like whip, some people call it, of like the MOCs really hitting for all the indexes and all the stocks like all at once, kind of like the more like final MOCs, and then they update again at 3:55. But there are some players out there that see them as early as 2 o'clock, and we and what I learned from that experience was you can see them as early as 2 o'clock. They were being updated for me, I think, every 2.5 minutes or something. But we tend to see bigger MOC updates and bigger movements that are actually occurring from MOCs, even if we don't know what the MOCs are, every 30 minutes starting at 2. 2:30, 3:30, and then 3:50 is the really big one. So I hope that helps. From Dave, I bought NASDAQ at 941 due to relative strength in that index at the start of the day. Okay. Great recognition of that relative strength. This was not based on a candlestick pattern on the 5-minute. I used the 1-minute chart to buy versus the low of an ignition candle at 940 and moved the stop loss to my entry at 941. Once we were at the start of 942 candle, this has been my best way to try and catch a momentum move for me. Is there another safer way to enter a momentum trade like that? Or is a certain amount of hit the bid offer as soon as it gives an ignition candle and pray inherent to that type of trade? I do think that, I don't necessarily love the way you described it, but I do think that some degree of hit the bid, take the offer as soon as that initial candle comes in, and then pray get the momentum is kind of the only way in those situations. You know, and I know this is why you probably didn't ask for feedback on this point, you know I take gripe with the stop loss, bringing the stop loss to the entry point, and just how tight that was even initially. I just think it's too easy to get shaken out of things that will still work. Even if the momentum doesn't fail, the trade can still work. It's like I want to at least give it a big enough of a stop loss where I know my idea for momentum is failing. But yeah, I mean, to directly answer your question, I think that that's really the only way, is that you're buying high to sell higher, or you're shorting low to sell lower to take advantage of momentum, and you think you see the momentum coming in, so that's why you're putting the trade on, and you, for lack of a better term, pray that the momentum continues of what you saw to actually pay you. So I think that's 100% the only way you can do it. I would personally prefer a little bit of a wider stop just to ensure I don't get shaken out and that the momentum can work for me. But yeah. Cool. Yeah, I haven't watched that yet, but thanks for sharing it. Dennis, thanks for the answer. Yeah, I wanted to plant the thought that if we get deals done at higher and or extended equity prices, we get the news cycle kick in with regular media outlets and sell it. Just same old. Yep, for sure. Over on the YouTube, do you think CTA positioning may provide a solid at least 3 to 4 week trend up? Tomorrow, gap up into 550 level. You think better short term short, or we pain trade into the 200 SMA and then we fail? I think a short term short makes sense if we gap up into 550, but that's like a day trade. I think that bigger picture, it looks to me from both a technical perspective and a positioning perspective that includes a general understanding of where the systematics are right now, that we're going to continue to go higher. But again, continue to go higher doesn't mean that you can't find some decent shorts along the way off of extension or what have you. From Kevin G, arguments I've heard, a lot of retail is buying the good news, thinking bad news is over and reluctant to sell it. If they too sell, could see sellers really move as much as buyers, and then we'll see massive selling for multiple days. Yeah, so retail has been very, very consistently buying throughout all of this. They have been really strong and consistently buying the dip, and I've seen speculation on, well, what causes retail to stop buying the dip, and something I've also been saying for years. I don't think retail is the dumb money that it was. I'm not going to say retail is smart money, But I don't think that retail is the dumb money it used to be. I think retail is a lot more educated than it used to be. I think retail understands the concept now of dollar cost averaging, and that it can be a good idea to be able to get good companies at cheaper prices in a market pullback. They have also seen now, what has modern retail lived through. They lived through COVID, which was a wild V bottom. Maybe they lived through 2018's pullback, which was also a V bottom. They even they lived through 2022, which was a little bit more drawn out, but they never got too hurt in 2022 because the depth of the bear market was not very big, and stocks eventually worked their way higher off that. So retail has kind of become programmed, one, through I think some degree of better education, and two, because it's worked, of saying, oh, I mean, my wife does this and it's great, and I've taught her not to be a trader but to be a good investor, meaning find companies that you like and that you believe in, and sometimes your account taking a drawdown, especially if you're a younger person with income, is not the end of the world, because you can buy those good companies at lower prices, and if they're good companies, they're going to work their way back higher over time, and the market always does seem to make new all-time highs again eventually. And if she'll overhear me doing like a meeting where I'm talking about, oh my god, the market is so smoked, she'll like say to me later in the day, like, oh, is it time to go discount shopping? That's how she thinks of it now. Is it time to go discount shopping? And I think that she, again, is just representative of a retail class of investor that has become more educated and has become rewarded from buying any bigger dips that have happened in the market. So they're not, the old school dumb money retail of, like, I don't know, the 1990s or something, is like panic puking into this down move. And most of the retail people I know who understand the concept of dollar cost averaging were buying it. And all the data and statistics we've seen on retail has shown that they were, they were buyers on the 10% dip in March, and they weren't sellers in the 20% dip in April. They were buying even more in the 20% dip in April. So I've seen a lot of speculation on, well, when do you lose the retail bid, and when do they puke out, and when do they become sellers? The direct answer is I don't know, but I think that they eventually, if they get actually constantly punished for buying dips, and you get a longer drawn out bear market, which we haven't seen in a long time, that maybe then eventually you begin to lose them as buyers, and at a certain point they may even become panic sellers. But it doesn't seem to be that way anymore. That might change also if the employment situation changes. We haven't really seen a major unemployment spike in a very long time now. I mean, we did in COVID, but COVID was different because maybe people weren't working in the same way. Many of them were working remote, but the government was handing out everybody checks. So yeah, maybe unemployment had a little bit of a pop there. People weren't working in the same way, but they were getting checks from the government at the same time that helped to offset that. And there was stimulus just coming from every angle at that time. Google is getting hit right now. Not sure if the conference call started. So that's the big question, is do we lose that retail bid? Because the retail bid has been helpful in this down move and has helped mitigate the degree of the down move, to be totally honest, because they've been really consistent buyers. See, there's more commentary. What else? So thank you for that, Kevin. Gabriel, think retail with the amount of information online, podcasts, know several concepts from the market. Yeah, for sure. Retail and options are blowing up probably. Yeah, because that's more gamblers. But so that's a whole different set of people, are like the Robinhood option gamblers. And, they might be blowing up, but so it's just different if you're a gambler, though. Because, I don't know, like, I really don't gamble, so I don't have as much like personal feedback on this. Like I want to make a comparison between like short term option retail traders and sports bettors on DraftKings and those similar type of apps. And I feel like almost everybody I know who consistently gambles on sports loses money in the long run on it. And that's almost what it's designed to do. So, but they keep doing it. I know people who have been losing money on sports for decades, and they keep doing it. Not necessarily insane amounts of money, but $20 here, $50 there, $10 here. And I think with a lot of those gamblers, the options is the same thing. I lost $30 on this options contract. When I have a friend, and he's primarily a sports gambler and loses money, and occasionally he loses $30 on an options contract. And I spoke to him one time about options, and he has no idea how options even work. Absolutely no idea how options even work. He's just like, yeah, I know it's gonna it's got to be above this price by the end of the week, and I'll make money. I'm like, all right, cool, have fun. So I don't know if that necessarily stops. I mean, you get the, what do they call it, lost porn or whatever. You get that. Those people obviously go bankrupt and go out of business, and they're not going to continue. They've blown up for good. But a lot of those options people are just gamblers, and they do it small, and they're probably not going to stop. Yeah, that's true. That's true, Gabriel. Oh, now you can make sport bets on Robinhood. I think Robinhood actually looks great as a stock. Chart, yeah, chart looks good. Chart looks real good above 45, and it kind of gapped up to 45 today and just went. Okay, I think I got through everything on the VTF and on YouTube for today. Have a great night, everybody. See you all tomorrow. And if you're on YouTube, thumb up.